Let me start by introduce Cekd Berhad. Cekd is investment holding company established in 1989. Its own 5 subsidiaries: Sharp DCM, Hotstar, Focus Wind, Worldwide, D Cutting Mouth, and KIT Technology. The group specializes in providing customized decutting solution for various industries including packaging, electronic, automotive, plastic, textile, and leather. They operate 6 factories located in Kuala Lumpur, Johor, Penang, and all are ISO 9001 2050 certified. Cekd is known for using advanced technology to ensure high product performance and quality. Overall, the company has built a strong reputation for its innovation and reliability in die cutting manufacturing. Next, we look at the profitability ratio. Profitability ratio are important because they indicate how well a company can generate profit compared to its revenue asset or equity. For Cekd Berhad, analyze this ratio over the year help determine if the company is become more or less efficient in turning resource into profit. It also tells us if the company is managed its operation effectively and whether it is sustainable in the long run. Now, let's move to liquidity ratio for the year 2022. Liquidity ratio helps assess a company's ability to meet short-term obligations using its most liquid asset like cash or receivable. In 2022, Cekd liquidity ratio gives us insight into the short-term financial health. A strong liquidity ratio means the company can comfortably pay off its debts or when due, which is crucial for smooth operation. We also want to monitor if there are too much idle cash, which may indicate inefficiency. In 2023, we continue monitoring Cekd liquidity ratio. By compare with year figures with those from 2022, we can observe any change in the company ability to meet short-term obligation. An increase in the current ratio may indicate better cash management, while a decrease could signal tightening cash flow. This trend helps both management and investors evaluate how effectively Cekd is managed its working capital. For 2024, we examine whether Cekd has maintained or improved its liquidity level. If we observe a consistent upward trend since 2022, it suggests strong and stable financial planning. However, a sudden drop in the ratio could be early warning sign of financial stress or poor cash flow management. A balanced liquidity ratio is essential to ensure smooth operation without missing investment opportunity. Next, we analyze Cekd leverage ratio to understand how much the company relies on debt for its operation. Ratios such as the debt to equity ratio help us assess the level of financial risk involved. High leverage can be risky, especially if income drop, but some debt are often necessary to fuel business growth. For Cekd, the goal is to maintain a healthy balance between debt and equity to stay financially stable and appealing to investors. Next, we analyze activity ratio, which measure how efficiently Cekd use its asset to generate revenue. These include inventory turnover, account receivable turnover, and total asset turnover. High activity ratio generally indicate strong operational efficiency, meaning the company is effectively managed its inventory, collecting receivable on time, and utilizing its asset well. For Cekd, maintaining a good activity ratio ensure that resources like machinery, inventory, receivable are not underutilized. It also supports better cash flow and strong profitability in the long run. Lastly, we take a look at shareholder return ratio. This ratio measures the return that shareholders receive from their investment in the company, which include dividend and capital gains. They help indicate how well Cekd is rewarding its investor and whether the company is creating value for them. Healthy return ratio are important because they boost investor confidence and attract long-term investment. For Cekd, maintaining strong return ratio play a key role in keeping investing shareholders satisfied and attracting new ones.